Here's a compelling reason for you to listen to today's show.
The stock market is not the economy, but financial conditions are the lifeblood of the economy. So you have to pay attention to what goes on across fixed income currencies, commodities, and equities and interest rates. You just can't ignore that.
That's Joseph Brusuelas, the chief economist at RSM. And yes, he believes the market is inflating a bubble and is due what he calls a healthy correction. But because the market's not the economy, he also thinks we're going to see continued economic expansion. Don't be confused. He'll explain all about it in an extended big interview. But we start today with Sam Borgi, staff analyst at Investors Observer, talking about the latest research on the Big Mac Housing Index, which is literally an index that measures housing affordability in the price of Big Macs from McDonald's. Plus, David Traynor puts an electric vehicle maker, but probably not the one you're thinking about, into the danger zone.
Want to hear about my weekend?
Yeah, you probably don't want to hear about my weekend, so I'll keep that short, but let's jump in because this is Money Life for Monday, October the 6th. And October the 6th, a famous day in my family because it is my oldest daughter's birthday. So I became a father for the first time 34 years ago today. I became a grandfather just about 5-6 weeks ago. So time flies because it's hard for me to believe I have a daughter that old, but happy birthday to my daughter Thompson. I am super proud of her. She is a teacher and I am sure she is a great one just because I would be excited to learn and do the projects and the things she talks about with her classes. So I could not be happier and more proud of her and my other daughter, Whitney, and what have you. But today it's her birthday, so we'll celebrate her day. We won't do too much of that here on the show because we've got a lot of other things to celebrate, like a really great interview with Joe Brusuelas. He'll be here for the big interview. Before we get there, yes, we're starting with what might seem a little bit ridiculous, right? Talking about housing prices by comparing them to the price of a Big Mac. But you need to understand that normally we talk about housing affordability and we only talk about it relative to houses. And here's the thing. In the last 3 years, the price of a median priced home in this country has actually dropped. But when it comes to the Big Mac Housing Index, well, the price of Big Macs was up. So you're looking to see how inflation in one thing relates to inflation in a very different thing and how that all plays out. And I won't give too much of it away, but not even I could eat enough Big Macs in a lifetime to come remotely close to buying even a house in the cheapest area for median priced houses. But again, if you're looking at places, I haven't bought a Big Mac in a while, but I know that the last time I looked, that was like $6 or $7. I know they actually say that it's less than that, but that would probably be the median price around the country. And I live in Massachusetts, so it might be higher here. And that could explain a lot of different things about how it works. It's a really interesting take on the market and the housing market that way. So those are the interviews. As for my weekend, well, I did spend virtually all day Saturday on a lacrosse field. And it was good to be out there, and I was better off than I thought I was going to be. You may recall, if you listened to the show on Friday, I suffered a fall. My knee was cut up, and I kind of had some road rash. And though it wasn't from the road, it was from falling on rocks on one leg and on one arm and what have you. And it turns out that the worst injury is probably to my pride, and one of my thumbs really hurts, which is never good when you have to type. Thankfully, it's my left thumb, so I am more dominant to right hand, though I'm ambidextrous in many things. And so I muddled through and was able to do this and was not hurting particularly, at least not because of the fall. It's still tough when you're not necessarily, you get out of season to say, okay, I will go and put in about almost 13 miles. So I did 13 games over the course of the day, which is an awful lot, although these were very young players, so you're doing a little bit less running and moving. But still, got in way more than my daily required steps and came through it okay, which is great. That's what you want to do, and enjoyed the rest of my weekend. I hope you enjoyed yours. But I did get a note from somebody who didn't bother to sign it, but who sent me something that maybe this is a question that goes with you. He wrote, Chuck, you're a downer. You keep asking questions about recessions, just trying to get people to say there will be one. Don't you see it's not going to happen? So long as the consumer is spending, the economy will keep expanding. And he went on to say that he really liked the interview with Ed Campbell, who was talking about how there will not be boom and bust cycles. He wasn't saying there won't be recessions. While he didn't sign it, and I wish he had, and I don't recognize the email address, so I can't tell you it's somebody that I've ever heard from before, so maybe he's not a regular or what have you. I don't think that asking the question is somehow rooting for recession any more than if I ask somebody about their nightmare scenario for the market is going to make it likely that their nightmare comes true. I do understand the data, and the good news clearly is that the third quarter U.S. GDP is estimated to have an economy that's growing at an annual rate that's like almost 4%. You cannot look at the latest numbers on business investment or jobless claims, or most importantly, consumer spending, and say that the economy is about to go belly up. I don't buy that. I also don't say that. And I'm not rooting for any sort of opinion other than a good one, not good as in positive, good as in well-spoken. But I will say that I can't help but feel that tariff policies have caused uncertainty, which is not good for capital expenditures and the expenditure cycle. It also confounds the supply chains. The labor force is not growing, and none of that is particularly good for the economy. And on a national level, the National Bureau of Economic Research defines a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. And NBER emphasizes a few indicators, including non-farm payroll employment and personal income adjusted for inflation, excluding transfers, consumer spending adjusted for inflation, industrial production. And all of that data is not available on a state-by-state basis. But Mark Zandi of Moody's Analytics, by the way, Joe Brusuelas actually mentions in our interview with him, says that you could get similar data and that 22 states and the District of Columbia would be in a recession now if you use that similar data, and that California and New York would be on the brink. And there was a study released last week by UCLA's Anderson School of Management, which stated that a recession in California is now plausible. So yes, GDP and consumer spending numbers are stronger, but the job market is weaker. And that at least makes me wonder how long the first two can stay strong. So that's why I ask questions like that. But I'm wondering how long the economy can stay strong, especially when pretty much any part of the country where the economy depends on farming and agriculture, mining and light manufacturing, or generally just the production of stuff, any of those economies is currently weak. So again, I think you have to ask those questions. I don't think it's rooting for bad things to happen. And I'm fine getting an answer that says, no, strong things are happening, and we get that mix. I don't care whether you believe Christina Hooper, who was talking about how she expects trouble to come, or Jeff Blazek, who was talking about how he doesn't. Christina from the Man Group, Jeff from Neuberger Berman were on successive days. My job is to ask them the questions. And if you think my asking them the questions is a downer, well, I'm sorry, I'm not going to stop asking the questions. If you think you have better questions for me, though, let me know, because I'm always looking to get better at my craft. And a number of you have sent criticisms at times that like you think are picking on me. No, I like to hear them. A couple of you have said, hey, there's this phrasing you use. Okay, maybe that's it. Maybe it's not so much the question, it's the way I'm saying it, something along those lines. Fire it at me. But honestly, if a recession doesn't happen, I mean, I hate to say this, but like go back to April of this year, like read comments that people posted about the shows and what have you, where we had people like Craig Callahan saying, hey, this is just going to be the start of the next bull market, and here we go. And people going, you're nuts if you see that. Go back to the beginning of the pandemic when they were talking about it's going to be years before this economy recovers. They had the same certainty of what was going to happen that you seem, whoever you are that wrote me this note, that you seem to have, that it's not going to happen now. I'm not certain of anything other than we got a show to do and I got to ask questions. But thanks for the opinion. Now you at least know why I'm going to keep asking those questions. If you've got a question for me or anything else, send it. Chuck at moneylifeshow.com. Right now, settle back and relax. I've told you what's coming. And yeah, we're going to start it off talking about Big Macs and housing. And it all makes sense to you right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Now Money Life looks at what the survey said. Yes, this is the survey said on Money Life. It's where we dig into surveys, studies, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And I got to tell you, we are introducing you to something new today. This is the kind of research that we like to sink our teeth into. In this case, literally, because we are looking at the Big Mac Housing Index from Investors Observer. And it looks at housing affordability in comparison to Big Macs. It is literally how many burgers does it take to buy a median priced home in the United States today.
I'd gladly pay you Tuesday for a hamburger today.
It's kind of like how many hamburgers are you going to be paying for on Tuesday, etc. It is a really interesting take, and we'll explain why it's not as silly or frivolous as you might think. We're doing that with Sam Borgi. He is staff analyst at Investors Observer, which is online at investorsobserver.com. But if you find Sam in our show notes, where we mention him in our show notes, or on our guest page at moneylifeshow.com, you will find a direct link that gets you to the most recent Big Mac housing affordability / index story. Sam Borgi, welcome to Money Life.
Thanks for having me. It's great to be here.
Let's talk about why this is not as silly as it seems, because when we talk about housing affordability, we're not normally comparing it to what we can buy with the money. We're just talking about here's a house. We're not talking about other sorts of things. And we're also not talking about it in terms of what's happening with other types of inflation, because the price of burgers does change. So why is it important to have that element that says, wait, we're going to compare housing affordability not just to other houses, but to something where the price is always in flux?
Sure. So the Big Mac Index, we're not as crazy as we sound. This is actually an informal tool that was created by The Economist several decades ago that looked at the purchasing power parity of a Big Mac across the world to compare it across different currencies. We wanted to take it a step further and look at how does this, common lunch or dinner item compare when it comes to housing affordability. So it's a very simple calculation. We wanted to take a look at the fluctuating price of Big Macs versus the median house price in the US and across states to determine whether or not it requires more Big Macs or less Big Macs over time to purchase a house. And what we found was that over time, it has required more Big Macs to purchase a house because housing inflation over time has outpaced many other categories, including the Big Mac. So some of the trends are really interesting when you take a look at it across different states. But overall, you were looking at hundreds of thousands of Big Macs in order to afford today the median price house when you take a look at the average price on a state-by-state level.
Yeah, and the price of a Big Mac, by the way, varies fairly dramatically. It's a little bit under $6 right now, I believe, but in some places it's over $7. So since you do this both on a state-by-state and a national level, do you see those regional differences where, relatively speaking, you find either housing or the burger is dramatically priced differently than the rest of the country?
Definitely. So we see, massive regional variation in terms of the Big Mac Index, mainly because housing costs are so varied across the country. As you mentioned, the Big Mac, it does fluctuate on a state-by-state level, but it's more or less in the $6 to $7 range. Obviously, it's more if you go for the whole meal. But for example, in a place like California, where you require something like 149,000 Big Macs for the median home, that reflects California's current state of housing, which is absolutely off the charts. Then you compare it to a state, for example, like Louisiana, which is only 46,000 Big Macs. Big Macs aren't that much cheaper in Louisiana. It's the fact that the median house price there is a lot cheaper. So a lot of it really does kind of confirm a lot of the regional housing trends that we've been observing over the last several years. We have seen the price of homes kind of stagnate a bit since 2022, and the Big Mac price has more accelerated since that period as inflation now trickles to other parts of other inflation categories, food, for example, meat, all that stuff. But overall, the index really points to how varied housing costs are across the country.
And we should point out that in 2025, median house prices are about $410,000. Big Mac, as I said, a little bit under six. So just about 71,000 Big Macs, which is actually down somewhat, right? That's we in the last couple of years, as much as we've heard about inflation and housing unaffordability, the last couple of years it's come down.
Yeah, inflation categories have come down. Food inflation has been somewhat sticky, I would say, since 2022. If you compare, for example, ground beef, cost of meat, it has remained somewhat elevated. But yeah, we're down from the peak when it comes to inflation. We're also a bit down from the housing market peak in terms of the price that we saw since the pandemic. Affordability issues are still rampant when you consider things like mortgage rates and all of that. But we are kind of backed off of peak inflation. Although the big debate now is how much longer will this inflation stick around? It seems like it might be longer than a lot of us had predicted before.
Is any of that change also in part because since the pandemic, people can have a little more flexibility to go where they want to in terms of if you're working remotely, et cetera? So you're much more likely to say, oh, wait, hold it. That house that I can get in Louisiana, I can say I can eat a lot more Big Macs if I'm going there because I'm not spending them the way I would in California. Has that also changed things in the demand picture?
Yeah, we definitely saw that after the pandemic. We saw a lot of people moving for remote work, and they ended up in states that were considerably, less attractive before from a housing perspective. So obviously, if you don't have to live in New York City or LA or Chicago, you might venture into the suburbs for the single family homes, or you might actually go to states that are a lot cheaper. So we did see that influx. Now a lot of those areas, even parts of Florida, for example, have become so expensive because of that influx. So it really does vary on a state by state level. Overall, the Big Mac index tends to show that the states that were always the most expensive for housing are the most expensive for Big Macs. California, Massachusetts, DC, Colorado, New York, etc. Whereas those states that are generally considered not as unaffordable, like Louisiana, Ohio, Indiana, are actually have the lowest Big Mac ratio. So it kind of confirms that trend. The Big Mac index kind of reinforced a lot of the trends that we already know.
And there is a serious point here beyond all of this, which is that when you look at the numbers and you start to think about, okay, if I move someplace and I get it, you're moving there for a job, you may get better pay and what have you. But if we relate the housing affordability issues and the inflationary trends there to what happens with, what we're spending our money on every day, it does kind of grab your attention because, oh, by the way, the number of Big Macs that you are not giving up to buy your property is money that you can be putting to the rest of your life and all those other sorts of things. That's a huge part of this. Do policymakers and the folks who are looking at this stuff, do they understand this relationship between not just housing prices, but housing prices and everyday goods?
It doesn't seem like they are. There's a really huge gap when you take a look at the deficit spending, you take a look at monetary policy. Right now, we have an executive branch that is telling the Fed to lower interest rates. And that's a huge break from convention. When we have lower interest rates in an inflationary environment, it risks triggering more inflation, especially for a lot of the most vulnerable people in society, which, for example, do not have financial assets. So if you're not heavily invested in stocks in the market, you're not benefiting from the monetary money printing, but you get left with the bill, which is higher prices. So this debate is raging on and on. I think from a housing perspective, one of the issues that policymakers still aren't getting is supply. Housing supply is simply not enough to meet demand, especially in the existing housing market. So we're seeing a very bizarre thing right now with mortgage rates and housing supply. for the first time in a while, existing home prices are now more expensive than new homes. Just giving you just a sense, because people who locked in mortgages back in 2021 below 3%, they don't want to give up their mortgage now, buy a bigger house at 6%. So the market is a bit locked in place right now, and policymakers usually play catch up. I don't really see a lot of solutions to the problem, both on the monetary side and the housing supply side.
Yeah, it's a really interesting story, and I love any story that we can tell in the tale of Big Macs, that we can bring, if you speak Big Macs, you're talking my language.
Hey, fat boy! Yeah, I'm talking to you.
Sam, great stuff. Thank you so much for joining me on the show. I'm sure we'll talk about this again down the line.
My pleasure, Chuck. Thanks for having me.
That's Sam Borgi, staff analyst at Investors Observer, which is online at investorsobserver.com. In our show notes or on our guest page where you find Sam, you will find a direct link that takes you directly to the Big Mac Housing Index. And you don't have time to eat a burger in this next break, but we're going to take a quick break. Don't go anyplace. We'll be right back with more of Money Life.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at vetify.com.
If you're looking for trouble, you've come to the right place. The baddest biker bar in the investment world. Welcome to the Danger Zone. Yes, this is the Danger Zone on Money Life. It's where we dig into the latest research from New Constructs, where they evaluate securities on a scale of most attractive to most dangerous. They do it by bringing together discounted cash flow analysis and forensic accounting. They dig in at the footnotes level and work their way up. And what they find is that the skin deep level, starting at the surface that most firms use, well, it can often be misleading. And if it's misleading and it works against you, well, that would make something dangerous. If you want to learn more about how it works, go to newconstructs.com. David Traynor is founder and president at New Constructs. David, great to have you back on Money Life.
It is great to be back, Chuck.
Who's in the danger zone this week?
Lucid.
Danger.
Lucid Group. It is ticker symbol LCID. This is a stock that has been on the zombie stock list, and it's done something that we don't see too often, that I don't normally consider a great sign of health, which is about a month ago, it did a reverse stock split. So in other words, it did a 1-for-10 stock split. So the stock is now trading at a much better price, but is that just fooling people, or, why is this stock? What's going on?
Yeah, it's just like it's a machination. I mean, hey, I'm just going to dramatically, reduce my shares outstanding or do a reverse stock split and make my stock price go up. I mean, they had to do it because the price was getting so low, they're about to be delisted. And that's the way to keep them from being delisted. This is a borderline zombie stock. And the only reason it's surviving is because Saudi Arabia's big investment fund put a bunch of money in, gave them capital to survive. So is Uber, but they're like right on the line, Chuck. Like this is, if any of these big investors are like, oh, we might not be able to be willing to fuel these losses any longer, it could go pretty fast. Back to the zombie stock list, that is.
We should point out, for anybody who doesn't recognize the name, Lucid makes electric vehicles. And maybe at this point, if you don't recognize the name of a company that's making electric vehicles, that by itself should tell you there's a big problem, because, of course, they have been going gangbusters. There's a reason why. They're not the only electric vehicle maker that's been in the danger zone, which has included, by the way, of course, Tesla, which you've been against for a long time, which has kind of fought back against you, but also Rivian and others. So is the problem the company, the industry, or both?
Both. I mean, it's a tough industry. I think we're seeing a lot of companies in the industry suffer. We're seeing, especially the expiration of the big U.S. tax credit, EV demand potentially falls even faster. It's already pretty much fallen off a cliff. And so these, we saw this is very similar, Chuck. We talked about this. It was, the EV car business is not that different from the original car business where you had a bunch of startups rush into it. Most of them didn't survive. You had too much capital chasing too few revenues. And we're probably, going to see a lot of these EV makers fall by the wayside eventually. And it's just, it's hard to guess which ones. And some of them, have super funding like Tesla. Maybe they'll be around. Now, survival is an altogether different thing than keeping the current stock price because, while we're not saying it's a zombie stock, we say, we're effectively saying it might survive. We are saying the stock price does have enormous amount of downside risk and is still super expensive.
Yeah. I mean, this is one of those things I kind of laugh when you start to look at profitability numbers. Well, I'm used to looking at companies that have profitability numbers that would show up in the negative side. That's not an uncommon thing. But things like net margins of negative 335%, those are numbers you don't see all that often. So, okay, not a zombie stock means it has more than 24 months of runway. But how out of whack is the price now that it's been readjusted thanks to this reverse split to about $25 a share?
Well, when we run the analysis, as you know, we always like to do, and what's implied by the current stock price, we show that to justify $24 a share, it's got to immediately grow from a negative 252% margin to 6%, which is between General Motors and Toyota. So that would make it a very profitable business. And then grow revenue at 48% compounded annually through 2034. I mean, like, come on. It's just even saying it sounds funny. That's what it would take to justify the current stock price. And that would put them at revenue that's 43 times where they are now. And it would put them at a place where they were selling vehicles that, basically selling, if they keep their current average selling price, it would imply they would sell 532,000 vehicles in 2034, which is way more than what they've delivered in the last 12 months, which is 13,000 or actually 12,000. That would be more than Camry, which is the best-selling passenger car in America, when they did 310 last year.
Obviously, we'd have to have a massive overhaul of the auto industry for them to get to that spot. But the guys who love a stock like this, what they say is, look at the industry. The industry's growing. This is just their growing pains. And as long as they keep growing, well, okay, you're paying for the top line growth. And they are growing their top line. They're just not growing it at the pace that you want. So what's the value of, the slight growth value or the no growth value?
Yeah, you're right, Chuck. I mean, this is an expectations call, right? I mean, we're not here to say Lucid's terrible. And by the way, in my opinion, it is by far the coolest looking EV. Like when I see one of those, I'm like, I stop and I'm like, man, that's a cool looking car. I love them. I think they're cool, and they are growing. Top line profits remain terribly negative, so that's not working at all. And despite this additional growth and scale, we're not seeing any improvement in profitability. So that's unfortunate because you'd like to see some scaling start to emerge and profit margins get better. We're not seeing that. Anyway, the point is, we're not saying it can't happen. We're just saying it's probably not going to happen as well as what's implied by the price per the explanation I gave you in terms of what's required to justify $24 a share. The no growth value of this business, negative 90 a share. So, we're talking about, anyway, you get the idea here, right? There's a lot of good growth and future prospects priced into this baby.
Negative 90 a share. Uh-huh. That's pretty much crash level. Is there stupid money risk here? Does somebody want to come and buy this company because, hey, they do make a cool looking car?
Yeah, I mean, you've got a market cap of 7.4 billion. You got 3.6 billion in debt and preferred capital as liabilities out there, right? So, and you almost have to add that on top of what you're looking at in terms of market cap in order to buy the business, right? I mean, I don't know, man. I mean, yeah, maybe. I mean, maybe the Saudi Arabian folks feel the same way I do, just like a super cool car, and they want it to exist, and it's play money to them, right? 7 billion would probably be play money. So Yeah, that's possible. I mean, they've already done what I would call stupid money risk by putting a bunch of money in here to a business that may not survive. But hey, man, it's, people think it's that cool looking a car. Gives them a chance in this day and age.
Yeah. But stupid money risk is not what anybody really wants to bank on. And that's about what it looks like you're banking on here. Again, this stock was worth closing in on $2 a share, did the reverse split. And when it has that kind of negative book value, you could see $2 again or less in its future. David, great stuff. Appreciate it. It's Lucid Group, LCID, the Danger Zone pick this week. David Traynor, thanks for joining me.
Great to be with you, Chuck. Thank you.
David Traynor is founder and president at New Constructs. Go to newconstructs.com to learn more about the firm, the most dangerous and attractive stocks list, their research, and much more. And speaking of much more, we've got much more to go on Money Life because up next, Joseph Brusuelas, the chief economist at RSM. He's checking in for the big interview right after this message.
Oh, wow. This is actually pretty dangerous.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Welcome back to Money Life, where it's time for the big interview on the October 6th show. And returning to Money Life today, somebody who, well, every time he's on, you guys tell me I should have him on more often. So here he is. Joseph Brusuelas is the chief economist at RSM. If you want to learn more about the firm, rsmus.com. Joe Brusuelas, it's great to chat with you again.
Thank you. Good to talk to you again, Chuck.
I want to start. We are recording this on Friday, October 3rd. And if we were living in normal times, there are economic numbers that we would have out today. Now, we're not expecting necessarily for this shutdown to go long, but the last one we had under a Trump presidency lasted 35 days. So it could. So although I want to get to you about where we are in the economy and everything else, I want to know from your perspective, how long does it take till you go, oh, now I'm doubly questioning the numbers?
You know, I've been doing this for the better part of 3 decades now. And as an economist, somebody who took too many classes in statistics and survey data sampling and econometrics, I'm okay with the benchmarks. They're not large, in my estimation, given the fact that we have 163 million people who work in this country and another 6 to 7 million that are unemployed. So I'm not part of the conspiracy ecosystem that says the government's fixing the data to confirm whatever point of view you might have, right? I'm okay with that. Now, in addition, we've always looked at a range of alternative data, whether it's the ADP, which we saw out this week, the home-based data, and there's a whole bunch of other ones, right? The bottom line is that hiring is slowed because of the pervasive fog of uncertainty that's driven by the large changes in trade and immigration. In addition, where AI is being integrated into the production of goods and provision of services. And it appears that the large corporates have slowed hiring of new graduates because we're able to substitute technology for that labor. So, when I take a look at the economy, it's pretty resilient, it's pretty dynamic. We're doing okay. I'm expecting it to accelerate largely because we're getting rate cuts. We've got tax cuts. We've got deregulation, right? And we've got full expensing, which, by the way, is retroactive to this year. So I think that we are going to accelerate, but, we're going to accelerate from probably 1 to 1.5% growth, which I think is what we're going to see this year, probably 1.5 to 1.7, excuse me, probably up to 2.3 to 2.5 next year. And then we'll ease back down to the long-term trend growth rate of 1.8 to 2%, right? So that's sort of a quick snapshot of where we are at. And I think much too much is being made of the benchmark revisions at the BLS.
I'm glad to hear that. I hope that that's the way things continue because, again, I don't want to see it be a political football, but I think we need to be data dependent. We think the Fed needs to be data dependent. given that the Fed has said they are data dependent, do they read the data? Where are you on what they're likely to do at this point? Because it wasn't that long ago where everybody was saying, okay, here comes the rate cut cycle. And now it's maybe not so much.
So the Fed gets to see all the data that we see and then some. Let me give you a good example, Chuck. The ADP data, which we get monthly, the Fed gets an update weekly from a company that basically operates the payrolls of 20% of the paychecks that go out in that workforce of 163 million. So they can put this together, right? It'd be better that the government shutdown be solved sooner rather than later. It's going to take about, or it's going to shave about 0.1% off GDP per week of the shutdown. That will hold until the week of October 12th to the 18th. That's the October 15 date, which is a twin date, a day of twin importance. That's the end of the reference period for the October payroll sample. The September payroll. No, it's the October payroll sample, excuse me. And it's also the day when the first paychecks of the military and people who are federal workers is missed. At that point, it goes nonlinear. That is the drag on GDP. At that point, it will jump probably to about 0.25%, 0.25 a week. And if you add that up, well, you end up subtracting about 1% off GDP this year if you're closed for the month, right? So we've got some time. It needs to be solved. And we need businesses, especially the clients that I serve, the small and medium-sized enterprises. They need to have that level of certainty out there in order to hire, in order to make investment decisions. And right now, we've got an impenetrable fog because the government shut down and we don't know what the taxes are on the imports that we're bringing in to make our products, right? And this is what I hear from our clients. And Chuck, I want to just point this out. This is decisively a non-political discussion. It literally is, we don't know what the cost of doing business is. Therefore, the proper risk-averse stance is, well, to do nothing, or at the very least to slow what we're doing down so that we can contain these costs until we are certain what they're going to be looking like going forward.
And yet, that's what you're hearing from your clients. They are slowing down. You are predicting slow growth, but you're not predicting recession. And I'll point out, Joe, that our last conversation, you and I, we spoke right after Liberation Day because it was timed with your release of your recession monitor. And recession had come onto everyone's radar, and everybody was talking about what the recession was talking about. And you were saying, hey, the recession monitor, the RSM US recession monitor, was flashing a lot of red. In spite of the fact that your clients are saying they're slowing down, et cetera, the recession monitor is not flashing red now?
Well, it's still flashing red in some respects. Like if you take a look at the housing ecosystem, right? Incredibly important, touches so many corners of the U.S. economy. It's flashing bright red, right? Yet the economy is very dynamic. Now, Jason Furman, the Harvard economist who was the head of the CEA under President Obama, did some original research and put it out this week. And what it showed was that, yeah, the economy slowed ex capital investment from tech. If you exclude that, the economy slowed to 0.1%, right? But that investment is really right now propelling conditions across the real economy. That's the area where it's a combination of profits from tech and leveraging up via private credit that's fueling that boom. Now, it's got its own associated risks, but one ignores that at one's own peril. Second, we have a K-shaped economy. The upper spur, where the upper two quintile of income earners live, is a different world. They have a tailwind due to their own income, return on investment, and equities. That's really providing a very strong tailwind. My friend Mark Zandi, who I used to work for, put out a very good piece a couple weeks back where he took a little bit of a different look than I do. I like the quintiles. He looked at that top 10%, right? And it's providing it accounts for almost 50% of all spending, right? What does that mean for those down market who live on the bottom spur? Well, what it means is they may have functionally different lives than those who live on the upper spur. They may face different economic conditions because we have a client base, Chuck, that mirrors the US economy. I mean, literally it does. It's a mirror image, right? From an economic and financial point of view, we hear different things from different clients. But the common denominator is that that fog of uncertainty has to lift so that we can go ahead and make those hiring decisions to pay that compensation and make that investment in tech that we need to modernize our business. So yeah, I have some very difficult conversations with select clients, right? The slowing, though, is not because of a bad economy. The slowing is due to policy changes. And at one point, those policy changes have to turn into policy certainty, or we're going to have a little bit more volatility in growth, a lot more volatility in hiring, and eventually this market, which is incredibly quiescent, it will experience that volatility too.
But we haven't seen that yet in this market. Do you look at the stock market? And I recognize you're an economist, but you do look at the market. Do you look at the stock market right now and see a bubble inflating, or no, this is not bubble conditions?
We tend to lean on our quantitative models, and we have an equity index that we look at that we've created, and it's one standard deviation above neutral. In the last 4 business cycles, each time that index has moved in that direction, where it's one standard deviation above where it should be, you tend to get a correction. Now, I think there are bubbles and there are periods of over-speculation where there's a concentration of risk in one area of the equities market. And I think that's the case this time. I think that we're due for a healthy correction. A healthy correction would be where the market falls, in that 10% range, and it squeezes out the punters and the speculators, right? It brings it back to earth. I do worry when I see, Meta openly admitting they're just leveraging up to pay for their data centers, right? They're building a data center in Louisiana that we're going to be able to see from outer space. It's that large, right? And, it's almost $30 billion in terms of its cost, right? And it's basically being paid for mostly by private credit. Okay, that's introducing leverage into an area of the economy that we really didn't see, right? So we're going to learn a lot more going forward here about that concentration of risk in the market, and if there's a related credit risk to the economy, should rates move in the wrong direction. So this I think really is a state of the art here, Chuck. The stock market is not the economy, but financial conditions are the lifeblood of the economy. So you have to pay attention to what goes on across fixed income currencies, commodities, and equities and interest rates. You just can't ignore that.
Well, let's touch on a little bit of that. Let's talk a little bit about the part that most people don't talk about in a lot of the interviews you do because they're skin deep in staying market and economy, which is currencies. You put out a commentary, because I do read your commentaries, that was talking about how there was some interesting data that basically suggested that about 90% of the world's transactions are being done in dollars, and that there is a broader impact of this. And I know that plenty of people are worried that the US and the dollar is not going to be the world's currency for long. But that statistic certainly suggests that something else is happening, like that's not the story here. But explain what you're seeing in currencies right now.
Okay, so one of the things that I think is interesting right now is that we're in a period where the United States is trying to close off exposure to the global economy due to the loss of 1 million jobs over the past 20 years in manufacturing. Now, I think that's a mistake, but nevertheless, that's the direction of policy, right? So you take that as a given. Well, globalization will go on without us, Chuck, right? Global economy is going to grow. And as it grows, the US dollar will play a smaller role proportionally over time. Now, that doesn't mean de-dollarization's happening. That's not what this is. This is simply de-risking due to the volatility that many global investors expect the dollar to be subject to as we follow this policy path. Okay. However, the dollar has structural advantages that other currencies don't. It's still the reserve currency. It's roughly around 50% of all reserves on any given day. On any given day, 90% of the transactions, the dollar is going to be on one side or the other. Here's the kicker. And I published this in the past. It wasn't part of this commentary that you kindly brought up. When the market closes every day, when the banks close, they have to balance their books, right? The repo desks, if payments haven't been made, they need to put up collateral to borrow money in the interbank market to balance everything, right? That repo market, Chuck, $12.1 trillion a day. And what kind of collateral would you think needs to be put up to borrow that cash, Chuck? Whose government security is going to be considered the fail-safe, right? Well, just take a wild guess, Chuck. Wild guess.
It's going to be the one that's already the dominant currency.
Yeah, it's going to be the 10-year U.S. Treasury security, right? And it's going to be paid for in dollars. Therefore, yeah, there's going to be some dollar diversification or diversification in currency markets. There's going to need other currencies are needed to make trades for a lot of different reasons. But the structural power embedded in global financial markets of the dollar simply is not going away. So reports of the untimely demise of the dollar are premature.
Let's move from that subject to where the data is telling us a different story. The hard data has all been good, strong, giving us the sense that you've been giving us on the economy. The soft data on consumer confidence says everybody's freaking out. So we can go a long time climbing the wall of worry while people are freaking out. But at some point, are fears realized? Like, does it become a self-fulfilling prophecy if consumers feel bad enough long enough?
Well, it definitely could. The reason why we put out a thing on consumer confidence this week is that the government shut down, which typically hammers consumer confidence if it goes on long enough. And if it goes on long enough, it tends to impact how firms allocate capital towards CapEx, right? So you don't want to see those. Now, we got some time on this, like I mentioned at the outset of the broadcast. But if we get to the week of October 12th to the 18th, that's when we go nonlinear. That's when the government shutdown turns from mostly noise to something that's a real risk to the path of consumption. And I think that that's the best way to think about this. However, it's important that we do differentiate between the hard data, which looks pretty good, right? It's hanging in there, and the soft data, like the ISM services data that was released this morning. Well, it's showing contraction, not recession, but a mild contraction in the service sector. Well, when people see that, then their opinion gets a bit dour, right? So we got a very uneven economy. And I do think that in certain pockets, things are stressed. Down market households are stressed. Firms that have exposure to those down market households, they're likely stressed, right? If you have exposure to the upper end households, it's a different world, right? And that's why the idea of a K-shaped economy that I mentioned all those years ago to you, it really holds. It's the best description, I think, of the current condition of the economy.
Do we ever get to a way where we somehow can look at soft data and account for that, where we can, do some sort of an adjustment and say, here's the upper K, here's the lower K, and here's what it means?
I think some surveys are better than others. Like if you want to look at inflation expectations, the New York Fed puts out a very well-designed, well-executed, well-maintained survey that says inflation expectations are 3.2%, right? Yeah, that's a strong, soft survey, right? But let's be frank about this. When we're talking about Conference Board University of Michigan, that reflects the polarization in society. Unfortunately, because we've devolved into separate tribes in some respects, when people get those calls or they answer them on online survey, they've been answering them for about the past 20 years with their own political or partisan preferences in mind. And you see that every time the White House changes hands from the parties, right? One set of respondents who says things were great while their guy was in charge, all of a sudden it's dire and it's at the end. So I think that some of the soft surveys simply just need to be retired. They've decreased in importance inside the market. When I was a baby economist all those decades ago, I'm telling you, Chuck, the real corporate sector and financial markets paid incredibly close attention to those consumer sentiment surveys because they were highly predictive of where consumption was going. Not so much anymore.
Do we also, if we're going to change that kind of data because it would make things better, do we also need to change the way we're tracking markets? Because we have an S&P 500 that is dominated by, 7 companies, 8 stocks, if you will, and it may not be as reflective as it used to be. So if we're going to be worrying about data quality and the rest, and we're going to try to come up with new measures, should we be coming up with a new or different or better measure? Or should we just use the old measure, but just use it on an equal weighted basis?
So when I was a baby economist, we cared about the Dow Jones Industrial. Remember that, Chuck? Remember when that mattered? Now it only matters on CNBC TV, right? We all migrated over the S&P 500 and the Russell 2000 and the S&P 6, the small caps, right? We got an incredibly diverse economy, and we need to look at several indices. But I want to be honest, and I want to challenge the listeners out there. We used to have a thing called the Wilshire 5000 because there were literally 5,000 equities out there, right? Well, the Wilshire 5000 is still out there, but in name only, and it's not given the level of attention it was when I turned 20 years old. Right? You want to know why? Because there's only about 3,500 stocks out there that are public, right? We've had a structural change. We're not seeing an addition to publicly available companies to the markets anymore. It's just ground to a halt. It's too slow, in my opinion. Therefore, we've moved towards looking at the real private sector, right? Like my clients, almost exclusively private. It's one of the reasons why I left Bloomberg all those years ago, over a decade ago, because it became very clear to me if I was going to continue my own growth and evolution as an economist, I had to have much better insight to what was going on out there in the real economy amongst those private clients, those private companies. And one of the reasons why I've got the coolest job on earth is I get to travel all around this world and talk to those clients. And it's made me a better economist. I think it's made me a better person, to be honest with you, to open your mind, to listen, to learn, to gain insight into how these companies operate, who they hire, what their financial condition is, who they borrow from, why they borrow, when they borrow. And, since the great financial crisis, when CIT, the primary lender to small and mid-sized companies, disappeared, well, we've had an evolution. We got JP Morgan, who's got a mid-market facility, right? But we haven't seen the maturation of those markets. Therefore, these companies that are vibrant, dynamic, good, are almost always under stress because liquidity is difficult at best for some of them, right? And when they do borrow, the rates are incredibly challenging.
Yeah, there's so much more I want to talk about, Joe, but as you point out, you need to be traveling the world, and I know that by the time my audience hears this, you will be across the pond doing some work in England and then over in France and what have you. So safe travels, but come back to us again in the not too distant future. Thanks as always for joining me on the show.
Thank you, Chuck.
That's Joe Brusuelas, Chief Economist at RSM. And if you want more information from him, rsmus.com. You can find him there. You can follow him on LinkedIn. We have his LinkedIn so that you can follow up on our guest page and more. And I will tell you, he does produce regular commentaries that are worth looking at. And you should know that because you just heard him. And speaking of things that are worth doing, it's worth sticking around to the end of today's show because, well, we've got a little bit more for you, but a lot coming this week. We'll let you know all about it when we wrap this one up right after this message. Man, it's always fun to talk with Joe Brusuelas. We've been doing it for years. He was a guest on the original Money Life when it was on WBIX in Boston. Yeah, and we don't feel like we're that much older, but we are. But always great to chat with Joe. I hope you enjoyed this show. We've got great things coming for you all week. But one of the great things that we had for you last week was the book interview that I did with Victoria Bateman. She's the author of Economica, A Global History of Women, Wealth, and Power. And we had a contest. The book is all about how women made the world rich. So we made the contest, which ran from Tuesday last week until Saturday, all about rich women, specifically the richest woman in the world. Now, you could have entered a few different names based on what list of rich people you looked up. But we were specifically looking, and we said this, we were specifically looking for the person who Forbes magazine currently counts as the richest woman in the world. And the answer to that is Alice Walton, the daughter of Walmart founder Sam Walton, who this year was reported to have a fortune worth $111 billion. And by the way, while she's the richest woman in the world, she's the poorest member of her generation in her family. She has 2 surviving brothers, and then she had a brother who died, I don't know, 10 or 15 years ago, I think in a plane crash. And at one point, that brother's widow was considered to be the wealthiest woman in the world. But then they realized that the way that he had passed the money along meant that she wasn't. But under any circumstances, Alice Walton, wealthiest woman in the world, not the wealthiest kid in her own family. Although when it comes to billionaires, right, okay, you got a few less billion than your neighbor or than your sibling. It really doesn't seem to make a lot of difference because they're all billionaires. Almost all of our contest entrants got it right. And from those correct entries, our winners are Junius in McLean, Virginia, Richard in Chula Vista, California, and Tim in Edwardsville, Illinois. Congratulations, guys. We will get you those books out hopefully this week, and they'll be to you in the not too distant future. Coming this week on Money Life, how about Jeremy Schwartz, Global Chief Investment Officer at Wisdom Tree? Meb Faber from Cambria is coming back to the show. We're talking on Thursday for Friday's show. And by the way, Friday, I will be traveling to a Cebu event in New York City, so we will be recording a couple of things early to accommodate my travel schedule. But we have great market call guests like Rob Spivey from Valens Research and Vijay Marolia from Regal Point Capital and more. Tony Turner, president of the TrendStar Group, will be here talking technicals. We've got a couple of book interviews and a couple of good things coming. So plan to be here each and every day. Meanwhile, well, there's a lot to celebrate today. And some of that is for me personally, because today is my daughter Thompson's birthday.
Happy birthday to you.
Yeah, hard to believe that she was born 34 years ago. I kind of think of her in sometimes like that time back the way I think of Declan, my grandson. Yeah. But you know how I should think of Thompson? This is the one sounder she's recorded for the show.
You're such a doofus.
Yeah, and she still sounds that way, even though she was much younger then. But if you're looking for something to celebrate that doesn't involve my family, there are plenty of things. It's Blue Shirt Day. Blue is the color for preventing bullying. The color blue was chosen because in many cultures, it's seen as bringing calmness and peace, as well as importance and confidence. It's also National Coaches Day, and a good coach brings confidence and what have you. It's National Plus Size Appreciation Day. I am plus sized. I appreciate it. National German American Day. I am a German American. I'm first generation American. My parents were both born in Berlin, so I appreciate that one too. It is National Mad Hatter Day, National Badger Day, which is about the animal, not the Wisconsin Badgers, though you could celebrate both. It's National Physician's Assistant Day, National Child Health Day, National Consignment Day. And yes, if you've got great stuff, why not consign some of it and get some money back for it? And then on the food front, it is Garlic Lovers Day. It's particularly good if you like garlic on your noodles because it's National Noodle Day, and you can down it with some orange wine because it's National Orange Wine Day. My guests today were Sam Borgi, staff analyst at Investors Observer. Go find the link to get directly to the Big Mac Housing Index story. David Traynor, founder and president at New Constructs, which is online at newconstructs.com, and Joe Brusuelas, chief economist at RSM, online at rsmus.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day, in honor of my daughter Thompson's birthday, comes from John Lennon, who, kind of like Thompson, said this. Said, I don't care too much for money. Money can't buy me love. Nope, and on your birthday, you get all the love you can handle and maybe then some, but every day you should keep money in perspective. And remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.